Well, greetings, investors. Welcome to our October 4th autumnal session, at least number 2 or 3 for this year of bull sessions. My name is Mark Robertson. I am joined here by Ken Kabula. And actually, Sean has actually joined us in the back room. Sean Mace. How are you guys doing today?
Afternoon. Doing great.
I apologize for my voice. It sounds like it's a froggy, but it's just the way it is. It's fall allergies, and they're in full swing.
Yeah, we got to look into some metals or some housewives cures or whatever they call them over the years. There's got to be something that can help you out, Ken.
Well, Mark, my doctor gives me stuff, and I take it, and I feel so spaced out that I decide not to take it. So I think I'd rather not feel spaced out and just sound a little strange than feel the way I do with the drugs he wants me to take. So.
Well, if you're going to indulge in that type of stuff, you have to share with the entire class.
No, they don't make me feel spaced out that way, Mark.
Oh, rats. All right.
Remember, my college days go back to the 60s, Mark. I understand a lot of things.
I know.
Okay.
I've seen pictures of you with hair.
Too.
What was that, Sean?
We didn't hear that, Sean.
You got to let us know what companies they're using too to prescribe that.
Oh, that's go with Glaxo. They need all the help they can get.
So we can do our research.
All right, so we are going to spend a few moments with Morgan Housel. It may end up being an introduction to future discussions, but Ken and I both read it recently. I know a number of the members of the audience have read the book. It actually was reprinted with a gold cover because of the number of copies that it has sold, and we will be adding it to our list. I'll probably put that list in next week's deck for the roundtable, the list of books that we found helpful to long-term investors, hence the picture of the bull. And
would you characterize it as an easy read as well, Mark? An enjoyable, easy read?
Well, like I said, I think I've read 3 or 4 books in my life in one sitting, and this is one of them.
Uh-huh.
And yeah, it was good. It was pleasant, and it can be read in a different style of a chapter. The chapters are basically standalone, and I just found it to be very reinforcing and an enjoyable read. He's a great writer, no doubt about it.
Yeah, I want to make that point with our audience again, to characterize this book as more of a collection of essays than of they all have the same theme, they all head to the same direction, but they are completely standalone in most cases. And if you only want to read a chapter a day for a couple of weeks, you can do it in a good 15 minutes or less, and it's an enjoyable, easy read with a lot of meat on the bones for you to pick at.
Yeah, there's a little bit of weaving, chapters together, but not anything. Yeah, they're standalone without a doubt.
Yeah, it's not like studying linear algebra, okay?
That's right. All right, we are going to spend some time with our best small companies again here for just a few minutes. Ken and I continue the hunt, and we'll visit that. But really, the question today revolves around the book a little bit. Your Brain and Money. Who will you be, Buscemi or Harris? And we're 1 month away from Halloween, and mine is a few days now. And our best small companies for this year, for the first time in 8 years, are lagging the market. So I'm feeling a little bit like Buscemi there in the center image from Armageddon when he's on the asteroid, sitting on the nuclear warhead. So rather than that, I've called in the big dogs, Ed Harris, to help us land Apollo 13 and the best small company portfolio. We're hoping to have a really solid October. And Ken was just saying that he thinks the Russell 2000 is doing relatively better. Let's hope that pushes us over the top between now and Halloween.
You had to really reach for that, to tie those all together, didn't you there?
Well, when you could too, Ken, if you would take some of your medications.
Okay.
No, Ed Harris, that comes from the powerful scene in Apollo 13 where basically everybody is getting ready for a funeral. And Ed Harris basically says, I think this will be our finest hour. And he straightens his tie and puts his vest on and proceeds to bring Tom Hanks and the crew down. So, yeah, it's a reach, Ken, but. And of course, that is the bear on the right because he's ever present. All right, let's go ahead and
I should, Mark. I should just relate when you're sounding really philosophical right now. I should relate what I heard last night when I called you around 7:30, 8 o'clock. Somebody answered the phone, and all I heard was, and since I knew you well enough to know that you were exercising and not doing anything else, I figured I had got you right on the tennis courts, and finally that's what you got out after you finished panting. So
very true. And for those of you that are willing to get on this victory train, I'm on a hot streak of 3 or 4 straight weeks of winning in a bracket that I shouldn't even be playing. So it's good. Times are good, but yeah, you did catch me out of breath a little bit. All right. Here's our quick disclaimer. Standard boilerplate. No investment recommendation is intended. This is all about education. It's the demonstration and illustration of philosophies, methods, and techniques of the modern investment club movement. The stuff that you hear here will bear our opinions, our attempts to implement and deploy all of these lessons that are now 8 decades in the making. Please do your own homework. We'll try to remember if we hold a particular security to let the audience know. I don't always do that. The next slide will help reinforce that. We do a round table near the end of every month on usually the last Tuesday, 8:30 Eastern time. It is a webcast. It is free, and it does have an outstanding track record. If you want more information on that, you can reach out to us. If you want to be added to a reminder list, please send a note to nkavula1@comcast.net, and you'll get a couple of reminders from Natalie. She will not inundate you with email. If you have any follow-up questions, if you'd like copies of slides, or you want to suggest a future topic, we do have some topics on the back burner right now that will be airing out shortly. Mark R at manifestinvesting.com, kavula1@comcast.net. Anything else, Ken?
nope. Let's keep going.
All right, here is my plain speak disclaimer that I just wanted to show that some disclaimers are different than others. This comes from an investment blog writer. I believe he's known as the Raven, and I'm not going to read it to you, but all of this applies here, including the fact that we get things wrong. Every once in a while, we forget to disclose that we hold a company. Please don't hold that against us. We're not doing that on purpose. And for the life of me, I really don't believe that. I mean, I've said it before, and in case the SEC is listening, I'm doing this with my tongue firmly planted in my cheek. Sometimes some of this stuff is like telling them you don't have a bomb in your suitcase at the airport. So this guy basically admits we make mistakes, things go wrong, but we're basically here trying to lean on each other and get it right and share some information. All right. Speaking of information, let's start with our relatively standard slide, long-term look at the market. The Jackson Hole continues to be the Jackson Abyss. We did close out the third quarter with quite a downdraft there on the right. So, Ken, it did come to fruition. And the green bar actually stopped down pretty low. Again, on the dot and the bar on the right will fluctuate between now and Christmas as we close out the fourth quarter of 2022. But the thing I wanted to point out is, this goes back nearly 25 years. There have been 3 recognized recessions in that time frame. We are most likely in one now. And the circled areas basically depict that gap or hole beneath the blue line for those recognized recessions. And again, this one back here was at the time regarded as the worst in stock market history, dating back to the 1920s. And the one we went through with COVID was no walk in the park either. The one that we're currently in could literally, by virtue of the size of that area, actually, because we're not done yet, the size of that gap, that white space beneath the blue line, could actually be quite large by the time we're done. And I thought we might talk about that a little bit. What jumps here, Ken?
Well, what jumps at me, Mark, is the fact that that last bar that is on the graph right now only has 1 day of data attached to it. So it has a lot of room to move up or down for that matter. So I'll reserve my either panic or elation until we get a little bit closer to Halloween to see where that bar is really headed. With 1 day plus half a day of trading today, it's going to move up a little bit closer to the blue line, and we'll see where it finally washes out 30 days from now.
Okay. And like I said, that's a work in progress. The size of that white hole on the right-hand side, we'll see what happens, but really doesn't matter. We don't invest in markets, we invest in stocks.
Absolutely.
And that kind of rhymes with this one here. It does show that the current situation we're in is a little bit extreme compared to history in terms of the number of stocks putting in new lows versus new highs. That's what the data is in the chart that's blipping around there. You can see that the blue trailing average has actually reached a new, at least a history over the last 20 years, history of lows. And we're in a moment. There's no doubt about it. You can feel it. You can feel it every time you go to the grocery store or pull into the gas station. But based on experience and experience at gritting our teeth, going back over the years, including this moment in time here, which was also quite unpleasant. Ken and I spent many a day back in the bottom of that trough on the phone talking about, what are we looking at here? What's the other side look like? I believe, Ken, that this is a valid premise right now.
Oh, absolutely. For finding things. I'm going to also, Mark, continue to talk to my clubs and talk to my investing partners and my family and anybody else that will listen that I don't think in my entire investing career I've seen the markets, not the markets, the people that follow the markets so completely, utterly negative about everything. I think every person that I watch as a talking head on one of the TV programs and pick any financial channel and pick any talking head, I think that the vast majority of them have figured out that gloom and doom makes people stop and listen to you. And if you're not gloomy and doomy, then you're not going to get the airtime that perhaps you would like to have. I lament the fact that I watch so much financial TV, and in fact, 4 or 5 days ago, after I finished Housel's book, I decided to cut myself back. It's like an addict, and I'm going to try to go cold turkey and not watch some of these things nearly as much as I used to watch them. I think they're bad for the psyche, they're bad for the market, and they're bad for the individual investor.
Yeah, it kind of reminds me to perhaps go back and look at the interviews, putting it lightly, on the comedy Daily Show, where Jim Cramer was interviewed by the host, and it was quite a strafing. Yeah, and it all revolved around something very valid, the 24/7, 365 news cycle. And I might go back and actually recapture that. So with that, a friend of mine, Scott Rupp, I think he's in the audience right now. Tip of the hat, Scott. Share just an element of Bob Brinker's newsletter, because here's one that's a little bit different. Now, Ken, you were doing a little bit of foreshadowing there with your notation about pessimism. We're going to cover that with Morgan Housel also. But what you're looking at here is just a kind of a current opinion from somebody who's not pessimistic. Now, there's a lot of words here, but I would draw the audience's attention that basically they're saying that stock prices have been punished, they've been pummeled, but the bearishness has reached the point where it's actually turning around and actually uses the word, it might be time to go shopping. Could be time to deploy cash into the market. So this is somebody who's got not such a pessimistic opinion. And any short-term weakness, they're basically going down here and say, hey, we don't know what's going to happen. Could continue to see some prices continue to slide down. But with all those things considered, including all of the geopolitical stuff, they're basically saying, get out there and be shopping, much like that tweet said on the previous slide. So I appreciate the counter opinion, Scott. And Bob Brinker is somebody that I have followed, not so much over the last couple of years, but for a number of years. And I know that he's been doing the radio show and newsletter for upwards of 40 years. So it's an opinion that does carry some weight.
Mark, do you think that a lot of the opinion that's in the market right now has to do with the age of the average contributor to the 24 hours news cycle? I'm thinking to myself that so many of them only can remember the COVID recession and the recession in 2008. And so when they hear the word recession, they automatically assume it's going to be something equal to or greater than what they've already lived through. Those were two ghastly times, but they weren't typical recessions in it by any means. And I'm, you know, I don't think that the market used to fear the word recession nearly as much as the news cycle today makes us afraid of that term and what's going to happen. And there's going to be hundreds of thousands of people out of work that are working now. And, that list just goes on and on and on and on, and it feeds on itself.
Well, the term used to be a pullback. That was the term that was used more consistently than anything. We're having a pullback. We just had 20% gain in the market. It's time for a pullback of 5%, 10%. The 24/7, 365 news cycle is spreading that fear farther and deeper. And I think it's just causing deeper recessions or deeper pullbacks more than anything. But it comes with greater highs too.
Well, it's easy to talk ourselves into almost anything. So,
yeah, and Housel covers that in the story implications of stories, good and bad, and how persuasive they can be. And I agree with both of you. I think that some of it is amplified and antagonized by the current media environment, and some of it does have to do with some of the newcomers not having experienced these sort of things. And I actually feel for that generation, Ken. There have been a number of things that have happened in the financial markets that just tarnish the situation. And I'm kind of sugarcoating here. And I'm not so sure we're not on the verge of another one of those with what's going on with Credit Suisse and other stuff. I went back and read some of the stuff that Hugh McManus wrote 15 years ago. And I just hope that we are strong enough to get through another one of those. I mean, heavens knows I don't think we can throw a whole lot more money at anything else. So let's see what happens. Hope for the best. Speaking of going back and looking into the archives, this was kind of fun. And this is something I want to kind of hammer home here. This is not idle chatter by the two of us. We've been talking about backing up the truck with a question mark. I think I'd remove the question mark today. But I went back and looked at some of those writings from McManus back in 2008. You can do it on the Manifest Forum. Search on this phrase, back up the truck. And you'll see what we actually had to say. And the reason that I think this is important, it actually dovetails with something that Morgan Housel also pointed out. I don't know what's going to happen, but in the current situation, it smells like an opportunity again. And again, for this quite young person that I'm talking about, that's a person with any time horizon whatsoever that isn't in the final few laps around the sun. And that is literally what we did. And then back in that time frame, and you'll remember this well, Ken, we actually did have kind of a back up the truck moment around Thanksgiving 2008. We were early by a few months, and then we had another back up the truck moment in March. And those worked out so magnificently well that I don't regret the November, quote unquote, I'm doing air quotes, bad decisions made in November and December, because they weren't bad, and they actually worked out very well. And Here's another Jim Cramer reference back from that time frame. Again, the time frame here was October 6th, 2008. We were deep into that bearish market. And just for fun, the performance of Costco since that moment in time is 18.6% per year, beating the market by 7%.
I think Costco points out also, Mark, that if you would have caught Costco at 55 or at 33 or at 66 and 20 or 22, there wouldn't be that much difference in price appreciation. That you don't have to hit the nail right on the head to do extremely well during these opportunity times. If you're a couple weeks late or a couple weeks early, I think you still have the same opportunity to hit one of those home runs. And Housel does a wonderful job talking about home run hitting. He doesn't call it that, but basically it's riding one or two stocks for a long time and knowing why you bought them.
Absolutely. So maybe we take a present day article on Jim Cramer with the Motley Fool. By the way, this is today's or yesterday's stock price, because the web page from 14 years ago still inserts today's price when you pull it up. So that is a current price down there in the box. But Costco was actually in the box back in 2008. All right, and here's the other reason that, and Sean, you're going to love this. The two boxes up at the top are basically depicting two fairly similar patterns between 2008 and 2022. And those two patterns are arguably very similar. I do think that there is one major difference. And here's kind of the point. You know, here was our back up the truck moment here by this red arrow back in around Thanksgiving time, 2008. And we had to wait a few months. But again, I don't regret any of the purchases that were made in this time frame when we still bounced around and continued a little bit lower. They have worked out magnificently over the years. So even if that were to happen again, I think it's like we've talked in recent weeks. It's an accumulation opportunity. And the other thing that I think that is a little bit different, first of all, if this is coming, we're not there yet. When the market really did take that deep dive around the end of the year back in 2008. The other thing that is rather dramatically different, if you care about this stuff at all, here's the death cross that actually happened back in that time frame. That's where the 12-month average drops below the 5-year average. There is no death cross here. In fact, the gap is here actually fairly strong. So, again, my advice would be go shopping. Buy some really good companies. It's probably okay to find some exciting small companies, which I think will rhyme with what we do between now and Halloween.
This is made so much worse by at the very end of the yellow box in 2008. It looks like it has literally a 5 to 7% jump just before it crashes again.
Mm-hmm.
Like, look at that bear trap or that bull trap there. And what are we doing right now? We're going up by 5-7% right now in 2 days.
Well, we'll see if we get another wrinkle like last time around. But again, I think the message is the same. Go shopping.
Oh, 100%. I would not regret buying right now either.
Mm-hmm.
And I wanna go back to that point that I made one last time, not to belabor it or anything, but I had wanted to own Apple for literally years, and my wife and I watched those charts, and we watched our SSGs from Better Investing, and we watched the visual analysis and did the homework and tried to come up with reasonable answers to whether the stock was a buy, hold, or sell. And one night in a program that we were doing in our local library in front of 50 or 60 investors, we pulled up Apple, and lo and behold, it sat in the buy zone for the first time in 7 or 8 years. It didn't turn out to be the best time to buy Apple during that recession, but it was a good enough time to buy Apple during the recession that we have a 25 or 30 bagger right now on our hands, 10 years, 15, 20 years later. So you don't have to hit the nail right on the head. You don't have to pick it at its extreme low. If it's a great company and your anticipation is that you want to hold it for the next 15 years, then go ahead and pull the trigger on it. Start bleeding money into it. Don't put all $100,000 into it all at once, but maybe 10,000 now and 10,000 in 2 weeks and 10,000 in 4 weeks and that kind of stuff. Because I think if you've identified what you want to own and what you might want to own for the next 15 years, you already have a list of 4 or 5 companies that you just wish that you could purchase. So go ahead and purchase a few of them if they say buy right now.
Yeah, I'm going to come at this one more time for reinforcement because your example is a great one, Ken. If you think back to the early days of Manifest investing, we put together the original Manifest 40, and that would be back in this time frame back here. You can go back and look. Apple was not even among the 40 most widely followed stocks by our subscribers. And then this moment in time hit somewhere in here. I'm not sure where. Apple caught the attention of a community. So, Ken, you were not alone.
Oh,
Apple
absolutely not. Right.
Yeah, Apple went from not even on the list and made it up to number 1 somewhere in this time frame. So it went from not even being on the list to becoming the most widely followed stock by our subscribers in that time frame, a position that it still holds today. So,
And I'll suggest, Mark, that when Manifest began, Apple was in that zone where a well done SSG said don't buy it. And people recognized it back at that first arrow that you drew there when Manifest started, but it wasn't in a lot of portfolios because people were disciplined and they had patience. Those same people are still investing today, and use what you've learned and put your money into stocks that you want to hold for the next 15 years.
all right, well, let's go ahead and press on. Here's our quick snapshot of the groundhog. Sean, you're still on the list. You've actually moved up today, by the way, with the action in the market. But we do have a new leader. That's Random Light. That happens to be, I think, Kay's in the audience. I believe that's Kay's husband. So maybe if the random entry stays at the top, we'll probably hear more about that. But some of the regular leaders are up there at the top. Some ladies making a strong play for the top. The monkey's back to number 12. And
I noticed that. Yeah. Let's just cross it off. Okay.
and it continues to be a challenging year. It'll be interesting to see if the market does get hot for a few days, minus Sean's pullbacks. See how this list actually proceeds. Kathy is still in last place, but if the market actually heats up, I wouldn't be surprised to see her make quite a move. I mean, she's got nowhere to go but up.
Well, with what's going on today, Mark, even the 2 or 3 folks at the bottom of the list might make it to 0,
Yeah, I think you're pretty close to that right now also. All right, so let's keep that average return going up. All right, and here's Ed Harris trying to bring us home between now and Halloween. By the way, the action in today's market has pushed the green bar for the Wilshire 5000 overall market up above 1600, so it's actually out of bear market. But you can see that the active continues to lead their traditional buy and hold version by a slim margin, and the Russell 2000 growth exchange traded fund has caught us. But in general, if the Russell 2000 does take off and behave well, if it behaves like there's a collective hope that will come out of whatever form of a recession we're in, that could be a good thing. Sean sent me a note that Boston Beer and a few others were up fairly strong today, so let's keep our fingers crossed.
Mark, I do want to put a commercial out there for Essent for us to take a serious look at it for next year.
Okay.
I think it was a bad sell from this portfolio in the first place, and I really think we want to take a good solid look at what it does business wise. and whether it has the ability to raise prices. Remember, it's an insurance company, and that gives it a lot of pricing power, especially if the insurance is required.
Okay, we can do that. Yeah, there's several on the list that will be in consideration to roll over. All right, speaking of said list, here is just a quick update on some of the companies we've mentioned. These are just candidates for further study at this time. We have not thrown some of these out based on the size. For example, Little Fuse is over $2 billion in annual sales, so that one will probably not make the final cut unless I buy Ken some of his favorite beverages or convince him to take his medications. But there are some interesting companies on the list at this point. And again, we're just collecting names. Ken, you had a couple you wanted to add?
Yeah, I would like to add KNSL. That's an insurance company. I'd like to add TGLS. They do glassworks, different kinds of specialized glass. And I'd like us to take a real serious look at ESNT.
Okay. I'll make sure that, I mean, it's on the list automatically because it's on this year's list, but
Exactly, yeah.
we'll make sure to roll it over. There are a couple on here. In Mode, which you brought just a few months ago, made this list. Your roundtable selection of Fox Factories here. I continue to like Little Fuse. And if we go up a little bit, we might actually catch some Generac also. But the ones that are up at the top there are kind of the ones to beat. And we'll have some discussions about, what characteristics we want to pursue most diligently going forward. Well, here's one that I hadn't thought of, and this one kind of inspires a flashback for Ken, some of the stocks he earned in his early days.
Thanks.
One time Ken had hair, and he also invested. Don't you tell a story of investing in a hair care stock back in the?
No, I don't. I can't remember having hair marks. So it was gone before I started investing. Okay.
Okay. But this one showed up in Barron's this weekend. I actually find it kind of compelling, and these guys are actually putting together. They've got 7 products in their pipeline, and I want to dig in a little bit deeper. But apparently, this stuff has some efficacy, and it's working pretty well. And I would call this a Bob Bilke tribute stock selection. Bob Bilke's on the Securities Review Committee for Better Investing Magazine. And one of his favorite themes is never underestimate male vanity. And I think it's probably pretty good advice. Here's a look at the company with its limited track record, but it's a promising picture unfolding. If this is a legitimate company with an opportunity field that's actually quite promising. Decent quality for a young company. Again, I would draw your attention to these are actual. 2022 will be actual here shortly. Decent expectations for the next year. Profitable early on. You can see that it's actually trading at its lowest price since the IPO. There may be a little bit of insider selling off situation there, but the star of this page are these 2 graphs. There's apparently profits to be made in male vanity. So it's an interesting story in the current issue of Barron's. We'll read it a little bit deeper, see what the boss has to say, but I'm going to put that on the list for further consideration as one of our more early stage / speculative picks, Ken. I think it's got a lot of decent characteristics, at least so far, merits a closer look. I promise not to tell a whole lot of hair jokes or anything.
Okay.
All right, here's your other favorite. This was also in the adjacent article in Barron's this week, just pointing out that even though the SPAC bubble has burst a little bit, Matt has had us following a couple very promising ones, including ChargePoint, which you mentioned last week, Ken. And again, early stage stuff, but could fit into the mix fairly well. Luminar was still on the list as one of the 6 that are okay, and a couple others that might be worth taking a look at. But yeah, that whole feeding frenzy has kind of died off a little bit.
Yeah, I thought we had CHPT on our preliminary list, Mark.
I
It
think we
belongs there
did.
if we don't. Okay,
Yeah, it's here.
good,
It's
good,
already here.
because
I think
I think that's a very interesting one to dig into and take a look at.
it's another one that's been as high as almost 30, and it's been kind of cut in half from the original days, and we'll see what it looks like. So here's a quick screen just to look for some candidates this week. I did not dig in deeper into. I looked at a couple of mutual funds in the past. Brown Small Company, did not find anything new and revolutionary, at least not yet. The hunt continues. You see the dogs on the right. The hounds have been released. But this is just a quick search for companies that have a decent return forecast, greater than 13%. I went for good or excellent quality, a minimum of 60, a growth rate of 12% or better. And then what I'm specifically looking for, especially over the last, I think as Ken said, we had 4 straight rather ugly days. There's a few companies that might be oversold, a relative strength index, RSI less than 30, and just looking for some decent candidates there. And I threw out the penny stocks. I went with a minimum stock price of 8 just to kind of whittle the list down to a manageable number. Some of these are too large to be considered for our small company exercise, but the ones with the little rabbits are probably worth a closer look. The name that kind of jumped for me a little bit was Claris. I do not know the company. Third one down.
I don't either, Mark. I've not come across it. I will tell you that Mesa Labs has been on a couple lists recently, and Mesa Labs is not the same company. It is the same company, but it's not the same business model and the same product line as you might expect if you owned Mesa Labs 5, 8, 9 years ago. They've had a change in direction, and if we're going to look at Mesa Labs, it needs a pretty deep dive again to come up with what it's doing today.
Does the visual analysis show that glaringly for Mesa Labs?
Well, if you remember, Mesa Labs had some production problems back around the time when a lot of us got out of that stock, and so I think that the visual analysis is kind of jumbled,
Yeah, that's what I'm
and
getting at.
they got new management in at the same time, and I think Mesa Labs right now is the kind of company you want to look at, maybe from a point of view that anything older than maybe 4.5, 5 years in data is data that we're going to take at really a lot less than face value.
Okay, duly noted. So those are some of the companies that will be running up the flagpole and seeing if they qualify for further consideration. All right, so with that, let's switch gears, talk a little bit about this book by Morgan Housel. My input on it would be, I was telling Ken before we got started here, I can only think of 4, maybe 5, maybe 6 books that I have read in my lifetime, and I'm a pretty good reader, where I've actually sat down and read it cover to cover, and this is the most recent addition to that list. Brad Perry's book was one from a few years ago, and I've done it a couple of times here in the last few years, but this is an easy read, and it's just a stack of stories that are pretty powerful and support many of the things. Very common theme running through all of this, so I found it most enjoyable, and I just love the thing up at the top that financial success is not a hard science, it's a soft skill, where how you behave is more important than what you know. And that fits right in with investing regularly, with patience and discipline. And this soft skill is the psychology of money. And a lot of it has to do with your environment to some extent. But you can learn on how to optimize and maximize the returns on the time that you invest into looking for stuff. And I think that's what one of George Nicholson's greatest gifts. What's your big picture takeaway, Ken?
Well, I really like and reread a couple different times the chapter. Well, he has them in chapters. Number 3, Never Enough, and just coming to grips with the fact that you didn't need constantly growing sums of money to necessarily meet your happiness quota. That the way that he wrote it and the way that he presents it makes it extremely clear that sometimes enough is enough, and you don't have to continue along the same lines that you've continued for the last 30 years in order to be successful at, and to say that you were successful. I really, really liked chapter 3. I also like the work, and 4 or 5 times he does work in the book on compounding, and he makes it sound so easy and so simple, and it comes across as boy, oh boy, why didn't I think of it in those terms? And the last thing that I really cared for in this particular book was the idea that why you bought a stock in the first place determines how successful you are with that stock. If my goal was to hold the stock for 3 days, and it took off and made 10% in 3 days, that might be my definition of success. And each one of us has a different expectation of what a stock should be doing and a different timeline for when that's going to happen. And that's important to factor into all of your investing. The guy is not so different from so much of what we read in financial financial tomes, financial books, but he's an extremely easy to read author. He writes at a very, very high level using a vocabulary that you don't have to read with a dictionary next to you or a computer with the financial terms, where you're always searching for, now what does that accounting term mean, and blah 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 blah. The guy is approachable. If you haven't tried it, just get the book from the library and read 1 or 2 chapters to start with. I think you'll be hooked.
Yeah, so with that, I thought we would spend some time just looking at some takeaways. One of the things that I focused on was this section of the book where he talks about some of the data and statistics and that kind of stuff and probabilities. And so I'd like to comment that the pessimism that we mentioned a few minutes ago was a part of it, along with the storytelling. He's a gifted storyteller. But those are 2 of the main parts that kind of stuck out for me. And let's kind of see where it takes us. He does start off the whole thing talking about a janitor that ended up with a net worth of $8 million with no particular really fancy way of investing. Just, again, successful investors are those that basically commit and stick to a discipline, and depends on who you are. So again, just want to go through just some of the major takeaways. This is actually from a blog writer called Next Level of Life. Many of the pictorials that you see here, and then you can actually go to YouTube and watch. I believe it's either an 8 or 15-minute video that covers the book. And I was just kind of fascinated to see the amount of coverage that this book has gotten in this style. And I was going to go back and reread the book, and I found myself spending time with these YouTube videos and some of the actual articles summarizing, kind of a Cliff's Note thing also. And this one here is just basically be humble and respect that I certainly don't, and we collectively don't have all the answers, and that a lot of times, as Ken just said, the success is self-determinant. And this just happens to be just a reminder that anytime you criticize or whatever, just remember that it is a collective circus. The good at I'm talking about circus in a good way. Anything on this one, Ken?
No, the first one just kind of lays finance out in front of you and makes it clear that it's life. Finance is life. You you need a way to support yourself and your family.
All right, here's a good one. Also, and this ties in with one that we're going to look at either in takeaway 6 or 7. It's never as good or as bad as it seems on the surface. And again, things get amplified. You can go back to what we were talking about a few minutes ago about the 24/7, 365 news cycle. That's certainly a situation. We're going to talk about pessimism in a few minutes, but again, there's just an overwhelming amount of information available out there. And he goes through and talks about how rare Bill Gates was, how rare and unique Cornelius Vanderbilt was. And I found some of those references to be fairly down to earth throughout the book also. And just some fascinating stuff about people who have been successful. And a lot of times it's just a matter of taking a good idea or a controversial idea and persisting and letting time do the work for you.
I'd like to suggest an experiment, Mark, that folks in our audience do for the next week or so. When you watch financial news, ask yourself whether they're optimistic or pessimistic. And it's especially interesting when you watch what's happening when the market is moving downward. Everybody's extremely pessimistic, but listen to the tenor of the questions being asked by the analyst community when the market is moving upward. They're still pessimistic. They're still saying, but what if this doesn't happen? But what if this doesn't happen? But what if we can't do this? They're still using negatives even on days when the market suggests we should be feeling a little bit good about what's going on.
And I think it was 2 Fridays ago, I confessed to you, Ken, that I had tuned in to CNBC, and I just about lost my mind. I thought I was tuning into a funeral. And the market was down several hundred points, and I think I may have commented to Sean about it, that it's just amazing sitting and listening to the background music that CNBC was playing was bizarre, absolutely bizarre.
Well, and I can understand it on a day when the market loses 1,000 points. But what happens on a day when the market gains 400 or 500 points? You still get this commentator, this constant stream of asking their guests to contemplate what might happen if none of the good things go good. If they all go bad, what could happen? Well, you back people into a corner and you get the answer that they want to get, which is, well, if everything goes to hell in a handbag, then it's going to be bad out there. And that's the answer they get constantly a lot of times, I think sometimes because of the questions that are asked.
Yeah, in fact, there was one just a few days ago where they were talking about we had that bull rally a few weeks ago, and they said, well, your 401k is up 10%. Are you aware that you're still down 10% from where you were 6 months ago? And it just makes my skin crawl, when they do that.
And that leads right into what Cheryl Smith was saying. Bad news is bad news, and good news is bad news.
Yep. No doubt about it. Okay, takeaway number 3, and this one ties into something that Ken was talking about just a few minutes ago, getting wealthy versus staying wealthy, and when is enough. Interesting. Morgan frames it in terms of watching individuals move the goalposts when they really shouldn't. And that's Lucy moving the football down there on the left. But, one major theme that he talks about a few times in the book, and I had forgotten the statistic, Ken, but back, I believe at the time that Morgan wrote the book, Warren Buffett's wealth was estimated at $85 billion. And oh, by the way, 81 billion of that happened after age 65. So 81 out of the 85. That's just staggering. Absolutely staggering.
Well, I haven't got to my first billion yet, but I'm waiting. Okay.
Well, Tin Cup is taking a hit.
Okay.
And the other individual there is kind of a folklore, absolute symbol, Jesse Livermore. And Jesse Livermore, and it's covered very well in the book, he basically had a day when he shorted the market the day before the 1929 crash. And he made the equivalent of anywhere from $2 to $3 billion in a day. And he was bankrupt 4 years later because he had gone out and full of confidence, completely leveraged. He went bankrupt 3 or 4 times in his lifetime, ultimately committed suicide. And it really is that kind of human notion of when is enough enough. And it actually nudged me to go back and grab Jack Bogle's book titled Enough and do a little bit of refreshing. Anything else here, Ken?
Nope.
All right. The importance of having a margin for error. Yeah, we're not going to get all these right. Things do change over time. Some people are critical of using history as a guide. That's an area where I would argue a little bit with Morgan. I do think that humans are involved. Humans are erratic. They don't always repeat what they do, but certainly taken collectively, you can argue that history can at least provide a bit of a roadmap. Yeah, change is always there, but the big thing is we should never be surprised by things that are surprising as investors. And diversify, don't get too carried away. All that stuff is covered here. But the margin for error that we have is the studies that we do, the patience and discipline that we do as we subject our stocks to the analysis, and then having enough of them without getting carried away to let them actually work for us. Is really what this takeaway centers on. Anything to add?
Oh, lots, but the only thing that I guess comes to mind easily, Mark, is that don't forget that sometimes unanticipated events are positive as well as negative.
Mm-hmm. Absolutely. All right, here's another one where I'm going to pick the bone a little bit with Morgan. He says that spreadsheets, life cannot be captured on spreadsheets, and I disagree. I've been hanging charts on my closet since college days, graphs and charts, and I'm a big believer in statistics and analysis and data analysis. And I don't know, would you consider me to be coldly rational, Ken?
Well, you're rational and you understand numbers, and that gives you a couple of steps up. I'm still not certain that the numbers tell the whole story, but I think it's important for us to know the numbers, to know the trends, to know the chances of something happening. I don't know, Mark. I don't know if his point on this here was so much about not studying and not using the statistics and reading history. I think his point might be to not try to follow history blindly, and that if a 25% return had come from every time the market did thus and such, maybe it would be reasonable for us to expect a 15% return and then be joyously happy if it turned into 18 or 20%.
Yeah, and I think I hear that from Cy and various others, including you, when you do a stock study. You often will show that high total return forecast and then the average, and basically talk about a range of expectations. And you're right, he couches this in probability and a range of expectations. A few years ago, Forbes or one of those firms had done a survey of what people expected returns from equity investing to be in the future. And there were numbers that were commonly in the 20s and 30s, and it's just like, whoa, our colleges and high schools need to do better because the number's actually down around 10 or less. And so
that's before inflation, Mark.
And that's, absolutely before inflation. So again, I think it is reasonable to build a representative expectation recognize that it's a range of outcomes that's coming your way, and don't basically depend on the top end of all your expectations delivering what is needed. So yeah, I'm being playful when I'm actually picking on him a bit here and picking on myself. And that one of the points that he actually talks about is this notion of relying on the information and the history, that this really is not as difficult as some people make it seem. And he makes the point that you get a few things right, and 7% of the companies that are in the Russell 3000, by the way, that's 200 companies. If you basically grabbed a few of them, in fact, Sean had sent me a reference that talked about grabbing some of those over the last several decades. Now, I'll include that in the notes and try to talk about it a little bit more next week. But this is something that is not impossible, and we do it all the time. And again, to the left there, this is something that we covered a few weeks ago. I just want to reinforce it, that out of 700 selections, over 200 of them have actually either declined in value or closed out at a losing position. Yet the gains from one company in the roundtable tracking portfolio is actually greater, and it's probably a bigger difference today than it was back then, because this was at the kind of one of the tougher points in the bear market. You can be wrong half the time when it comes to individual stocks and still make out massively.
I very tentatively dip my toe in the water, Mark, and say that number at the first half of that sentence might even be as high as 2/3 of the time.
Yeah, you can actually get to a situation where you're still doing just fine with that batting average, so to speak.
Yep.
So good stuff. And he's just pointing out that I think some of the pressure and doubt and fear is self-imposed. And part of that's education. But again, many of you in the audience collectively have had such wonderful lifetime experiences in investing. You and I, we need to share that somehow. And that's a lot of what we try to do. Right, and here's kind of coming back to that pessimism and media topic. Morgan certainly knows this well. Storytelling is powerful. And in the case of economics, it becomes very easy to quickly focus on the negatives, the negative narratives. So just something to be aware of as you're trudging through stuff. One of the things I found interesting, Ken, was he went back and quoted the Factfulness text and the author, Hans.
Yes.
Yes. Several times when he's talking about this stuff, a lot of the stuff that is negative and fear-inducing is false when you dig in a little deeper. So, Hans Rosling, right?
That's his name, right? With his son and daughter wrote the book Factfulness, right?
So again, question and dig deeper and keep going until you basically have the core principles established by George Nicholson in the Modern Investment Club movement. When you're trying to understand a company, make sure you understand the visual analysis, the business model, the growth characteristics, the profitability, and all that stuff, and understand it to the extent that you can decide whether or not it's true and something that could be feasible in the future. And I guess we'll close with this one. Again, I just wanted to make the point that as I was going through and looking at this kind of stuff, here's another one. This is from a place called a blog, The Swedish Investor, also on YouTube, that covered his book review. And this is just one of the points that he makes. And again, it's just underscoring something we've already talked about ad nauseum, but this fact that it's a condition that the negative, pessimistic stuff catches our attention faster than the other, and that's unfortunate. Anything else, Ken?
I'll talk about it at a different bull session, Mark. I would like to get a little bit deeper into some of these facts that we use as facts. I'm thinking about facts that over my lifetime I've been beat over the head with until I'm sick and tired of the fact. And I know the rational side of me says the fact has to have changed over the 50 or 60 years that I've been dealing with it, and yet that fact is still out there and being trumpeted from the tops of the stairs of the Capitol and everywhere else. The one that I'm thinking of specifically, and please don't send me terrible emails or anything, but I'm thinking about the fact that says that women only make 70 cents compared to every dollar a man makes. I first sat down at a negotiating table across from my school administration in 1972. And that was the fact that was being used in 1972. That's 50 years ago. I certainly would say to anybody that if that fact hasn't changed in the last 50 years, then all the progress that I've seen when I started school, there were no female administrators, there were no female sports, there were no female coaches. And so if these kind of facts haven't changed in 50 years, then we've done an abysmal job of trying to raise women's wages to match men's wages. I have to believe that those facts have changed, and yet I'm still listening to people tell me that women only make 70 cents compared to every dollar a man makes. Facts have to change if there's going to be progress made, and I've read a number of articles which lead me to believe that that first fact that was drummed across the bargaining table at me was probably based on a study, a single study done at a single university that was deeply flawed, both by sample size and by lack of real true statistical analysis. So
and there was some stratification there too, where they weren't comparing apples to apples.
Yeah, so terrible example maybe, but I like that. I don't like this idea that everything is static if it's useful to sell the argument. There have to be things that change, and I certainly hope that you and I have changed quite a bit in our approach to investing and to helping investors over the last 25 years, so that we still have basic core principles we believe, but we've become a little bit more sophisticated in how you achieve those goals. I think that's where Housel's coming from a lot of times when he indicates that pessimism is so easy to use compared to optimism, which many times sounds like you're, well, this guy that did this graphic sets it beautifully, that what are you trying to sell me now? You know, this kind of thing.
Yeah. Well, maybe that is something we can dig into a little bit deeper. I noticed that, funny you should mention coaches. During one of the NFL games just yesterday, there were either 3 or 4 female coaches for the two teams on the field. I mean, and that obviously was 0 as much as just a few years ago. So please don't try to tell me that there isn't some progress being made. All right. And then, of course, this one, which we already knew, but Morgan points it out. That's straight from the book. Time horizon matters. So with that, here's our reminder that we do archive these sessions on YouTube, both the roundtables, the bull sessions, and any other educational things that we do. Please subscribe, and we'll let you know when we add content. We are up to 926. We'd like to gain another significant digit on that sometime in the near future. And we'll leave that with what I thought was kind of a ominous, but face to face with the bear. Anything else in the hopper, Ken?
Well, I'll answer one question to the audience. I negotiated contracts for school districts for 45 or 50 years. My master's degree from the University of Michigan is in labor relations, school negotiating. So it became something that I not only learned, but I practiced then. That in addition to switching sides and moving from the teacher's side to the administrative side, and running a 712 high school with about 35 staff and about 450 7th through 12th graders. That was the sum of my experience. It's limited in a lot of ways, but in a lot of ways it exposed me to a lot of ideas that the average teacher or principal would never have even thought of, let alone argued in front of an audience about.
All right. Any other questions in the hopper? So we'll leave the audience with their question. Which one will you be, Mr. Bashimi, writing the nuclear warhead, or Ed Harris? And everybody say a prayer, have a thoughtful moment over the performance of our small company portfolio between now and Halloween. Anything else, Ken?
No. Thanks, Mark. Thanks, folks, for coming today. It's appreciated as always. And
I'm sending you lemons.
I'll talk to you all. I need a cup of tea right now, right?
All right.
Okay.
Thanks, Ken. Thanks, Sean.
Good night, everybody.
Good talking to you.
Thanks, guys.